Everyone, Maurice and welcome to Things Invest. Talk about investing, finance, fresh development for today's favorite items only. The investment on top of today would be the overall market index. So I've been getting this question quite often lately. Is a market correction coming? Are we gonna see a market crash coming? So I'm gonna bifurcate, or divide up the index into three pieces, right? The SPY, the S&P 500, the Nasdaq, and the Dow Jones Index, right? And I'm going to dissect each one by performing a technical analysis on each one to see how severe is each index going to be potentially correcting, or are we not going to be correcting. So stay tuned, stick around, let's make some money. All right, so moving on to the technical analysis for the respective indexes. Obviously, today's a Sunday, so the equity market is not open right now. But we could take a look at that historically and see how the predictability is going to look like going forward, right? So with respect to SPY, let's just go through the order that we have here, right? So SPY, you can see that we've had this upward trend, for quite some time now. And you see these oscillations here. These oscillations are mainly driven by the macro catalyst, right? With respect to earnings, but mainly driven by, I would say more of a primary factors, mainly coming from the FOMC meetings and the CPI report that we're getting from the Feds, right? On understanding the outlook for the inflationary pressure and the quantitative tightening plan that we'll be hearing more and we'll learn more from the Feds going forward, hopefully by Jackson Hole from Jerome Powell's speech coming up. So, but the oscillation is mainly driven by those, right? Basically see a dip because of the fear from obviously, are we tapering? Are we gonna be cutting off the monetary supplies for corporations? Are we gonna get our stimulus checks going forward? Whenever we get those fear, we obviously have a dip, right? By the fear, right? And you have subsequently rebound because it's like, oh, it's not that bad. Feds is gonna be basically gradually gonna taper going forward, but it's not gonna be a sudden fashion. And it seems like every single time we hear something along the line has this comparable affectation to it, right? You basically sell the rumor and buy the news from there. So it's like kind of a reverse psychology perspective, right? So what I see going forward, right? I think based on just taking a look at SPY real quick, I think a correction is coming, and the correction wouldn't be a seismic one. I think it will be, more of a moderate level, right? Firstly, you can see that MACD we are slow. We just formed a cross, right? And that cross was mainly driven by on the 20th, right? And then you see that we have been searching up ever since, you know and you see that the scoop is kind of forming down right now. So it was a relatively short fuse of scoop because of the 20th was basically driven by the FOMC meeting, right? We got the confirmatory news from Jerome Powell that the inflation is going to subside a little bit, but tapering is not going to be happening anytime soon. But it's something they have to watch for because the job number is their mandates that they have to be mindful of going forward. So, and that's why we see this, kind of a subtle recovery, and that's why you see that golden cross here, right? But right now we are kind of in the waiting game, right? How's inflation is going to be happening, right? What's the plan going forward, right? Because ultimately, we need to have some sort of strategy or some sort of blueprint on how we can appreciate the US dollars going forward as we obviously recover. But we've been printing so much money for a year and 8 months, 7 months so far that, I get it. This is the easy way to do it. This is the easy way to, just print more money by depreciating the US dollar and hope that eventually the corporation is going to revive back up, that the US dollar is going to start pulling back up by you just basically pulling money out of the market a little bit more by loosening their asset purchasing, on a monthly basis going forward, right? So I think we should be seeing some sort of a correction coming, and I think what the catalyst of on driving that could potentially be the Jackson Hole, right? The Jackson Hole speech. We'll hear more about the updates on the tapering plan, about the inflation's plan, and I think by then we should see some fear driving this sell off, and I think we ideally go back down to maybe the 428. So it wouldn't be like a seismic one. It'll obviously be a moderate level of sell off, but I think also on top of the fact that RSI is we're not overbought or oversold. We just kind of at the moderate level. So I do see some sort of like a moderate correction for SPY coming, and I think Jackson Hole could potentially do it for us. And I think the contingency is really the tapering timeline going forward and how severe that will look like. Contingent on the job numbers that we are also going to be able to sustain, which is another question mark we need to kind of verify going forward, right? And that's the mandate that the Feds want to focus on, right? So that's a real factor that we also need to incorporate into our adjustments. So next one is Nasdaq. So Nasdaq is a little bit more normalized. So I don't really see a major sell-off coming. You could see that we crossed for quite some time now, and the volatility is kind of interesting. And this again was mainly driven by the FOMC meeting with the inflationary outlook again, right? We kind of hover back up, and now we're just kind of cooling down because the FOMC meeting was it's still a foreshadow positive affectation. It's not like a confirm that okay the economy is slowing coming back up, and also on top of the fact that the COVID cases seems like it's spiking again, right, with this Delta variant. So something to be mindful of. I think another factor that's coming would be contingent on obviously the Jackson Hole conference or the meeting that we'll be hearing more about the inflationary pressure. But I think comparable to like SPY, I think the correction should be moderate. It shouldn't be like severe, like the ones we've seen in the past, right? Not like the March crash that we had back in the day when COVID hits, right? I think just like a normal correction, and I think it's needed ahead of obviously as we shift into the late Q3 Q4, which is typically the sector rotations for a lot of hedge funds to be pumping up the stocks again, right? For the Santa Claus rally, if you may, right? And I think the chart makes sense, right? And comparable to the SPY, you could see that we're moderately trending accordingly. We're not overbought, we're not oversold. We have been depleting for quite some time now. So I think, by Jackson Hole, we might see some fear and then come back down to the 14,500 or 14,450 and then slowly bounce back up ahead of the rally and continue this bull cycle that we're currently in right now. So lastly, for Dow Jones, Dow Jones is very similar to SPY. If you look at the MACD and the trends, makes sense because the composition of the stocks is within that index, right? You could see the oscillations comparable again to SPY because of obviously the FOMC meeting and the CPI report that we've been getting so far is really mainly driven by inflation signals that we've been getting. So Dow Jones, I do see a correction coming, but the correction should be a little bit more severe in comparison to SPY. And you can see that we do have a relatively large gap they need to fill, right? And also on top of the fact that we cross up because again that signal from the Feds on inflations, but we are in the propensity of crossing back down. You see that curvature right now. RSI we are at a moderate level. But I think a correction for this is needed. I don't think it's gonna be like super steep. I think we'll probably get somewhere around potentially like you see there's some substantive level around like the 341, right? So it's not like a huge sell off, but we will need to sell off a little bit before we continue to leap up from there, right? And I think again the Jackson Hole inflationary outlook. Again, FOMC meetings, CPI reports, those are the things that we need to watch out for. Also on top of earnings, right? Expectations from the Wall Street consensus on the respective stocks that's within these indexes, right? So something to watch out for. I think correction is is coming, but it's not going to be like a huge one. And I know that media affectation are screaming like, "Oh, market crash is coming because of this and this and that." I think it's going to be more moderate than that. I don't think it's going to be that severe like the people are screaming. But again, right, whenever you read any news, you have to take it with a grain of salt, right? And by applying logics and look at the charts, we can tell that the sell-off will be likely to occur, but not going to be as severe or as aggressive. Aggressive, that's the key words that they are trying to enforce on us to drive fear. Fear mongering is one of those factors that often drives sell off, right? But actually, the real reason behind sell off is really hedge fund liquidating slowly, And when they sell a large chunk of portions with a big liquidation event, it drives fear among, and then these you see a lot of negative news, and that subsequently tank the market from there, right? And I don't think that will be the case because the economy should be reviving back up. This is a gradual process we need to slowly, perform going forward. It is a delicate dance between the different factors, right? And eventually, we should be sustaining a relatively healthy bull market by the end of this year. Obviously, to potentially reach all-time high for multiple stocks that are in our portfolios. So hopefully this is helpful. All right, so that's it for their respect my technical analysis on the market indexes. Hopefully this is helpful into giving you that clarity on what's the technical analysis telling us right now, right? Without any bias. It seems like the correction should be coming, and it's logical why that is because of the timing and because of the economical outlook and the timing for the respective market factors that we've identified so far, right? But feel free to ask me any questions if you have any questions. It's nothing to be worried about if you hold any equity right now. I think this is just a normal market cycle needs to go through. It's healthy. It needs to be happening. So would I be advising buying now, right? I think if you want, why not just hold it for a while? But I think there's a more opportune time coming, right? So really appreciate you and stay tuned for this coming up. Take care. Bye.